You're not imagining this. A war thousands of miles away can reach directly into your retirement account before it ever reaches your daily conversation. It happens through oil, through inflation, through interest rate expectations, through risk pricing, and then through the oldest, most dangerous transmission system of all, your own nervous system. That is the part almost nobody explains clearly. People keep telling you to watch the Middle East, watch crude, watch the Fed, watch your mutual funds. Fine. But the real danger sitting in front of you before April is not only what Iran, Washington, or the Strait of Hormuz does next. It is what you do next while your body is under threat. Reuters reported on March 24th that oil rose again after Iran denied U.S. talks, with Brent back around $101 a barrel, and analysts warning that if the Strait of Hormuz disruption drags through April, Brent could reach $150. AP reported that the war has already upended the Federal Reserve's expected path for rate cuts by pushing energy-driven inflation risk back into the center of the market conversation. That means your 401k is not reacting to one story. It is reacting to a chain: war pressure, oil shock, inflation, fear, rate uncertainty, equity volatility, then panic inside ordinary investors. The 1:17 a.m. scene that is happening in real life. Picture a 43-year-old guy named Eric, not reckless, not financially illiterate, just tired. It is 1:17 a.m. He opens his Fidelity app because he cannot sleep. His 401k is down $28,400 from a recent high. The next morning, he fills up his car and notices gas is up again. On his phone is another headline about oil, Iran, shipping risks, and the possibility that the next few weeks could get uglier before they get calmer. He's not thinking in textbook language. He is not saying, "I am now exhibiting loss aversion and anticipatory threat sensitivity." He's thinking something much simpler and much more dangerous. Maybe I should move this to cash until things settle down. That sentence sounds reasonable. It sounds prudent. It sounds like a man protecting his future. But for a long-term retirement investor, that sentence is where a temporary market drawdown starts becoming permanent damage. Because once fear gets to call the shots, most people do not sell once and then re-enter perfectly. They sell, wait, hesitate, second guess, miss rebounds, then anchor to the price where they got out and turn one emotional decision into a multi-year wealth leak. Vanguard has been blunt on this point. Investors who sell during market turmoil and move to cash have historically underperformed those who stay invested, and the longer they stay out, the worse the underperformance tends to get. Why this title is not clickbait. Some people hear a title like, "The US-Iran war is killing your 401k," and assume it is exaggeration. It is not, at least not in the mechanism. When war threatens energy flows, oil reprices. When oil reprices, markets immediately start recalculating inflation. When inflation risk rises, investors have to reassess how quickly the Fed can cut rates, or whether cuts get delayed altogether. Reuters reported that Morgan Stanley pushed its next Fed cut forecast from June to September because of inflation fears tied to the Middle East energy shock, while other policymakers said there is no single clear path for rates right now. That matters because stock prices are partly built on expectations about growth, margins, discount rates, and liquidity. If the market suddenly has to digest more expensive energy and a murkier rate path at the same time, volatility is not some weird side effect. Volatility is the expected result. So no, your 401k is not randomly falling because investors are emotional. Investors are emotional because the math got harder, and then their brains made it even worse. What your brain does when red numbers feel like danger. A landmark PNAS study found that people with bilateral amygdala damage showed dramatically reduced monetary loss aversion, suggesting the amygdala plays a key role in generating the fear response around potential losses. Another study found that cognitive reappraisal reduced loss aversion and decreased amygdala responses to losses. Put that into normal language and the message is clear. When you see your 401k falling, your brain is not merely disliking volatility. Your threat circuitry is helping create the urge to stop the pain now. That is why a portfolio drawdown feels physical. Your chest gets tighter, your jaw hardens. You keep checking. You want immediate relief. And immediate relief in investing often looks like exactly the wrong move. This is why smart people panic. This is why people who know the data still do stupid things in bad weeks. And this is why telling yourself to just be rational usually fails in the moment. You are trying to make a 20-year decision while your body is acting like something is chasing you. The problem is not just fear, it's anticipation. Here is where war-driven volatility gets even more psychologically dangerous than a normal correction. A normal sell-off can feel ugly, but at least it often feels impersonal. A war oil rate sell-off comes with countdowns, briefings, denials, rumors, satellite images, and endless what happens next speculation. That matters because uncertainty is not a neutral condition. It is a stress amplifier. AP reported that the Iran war has narrowed the Fed's flexibility, and Reuters reported that Fed officials now say there is no single, most likely path for rates if oil stays elevated. In plain English, the market cannot model the next few months with much confidence, so every headline hits harder. And when every headline hits harder, investors start acting as if they need to do something immediately, even when the correct move is to make fewer decisions, not more. The big lie your fear tells you. Your fear will try to sell you one very seductive idea. I'm not panic selling. I'm just stepping aside until things become clearer. That sounds intelligent. It sounds adult. It sounds like risk management. But for most 401k investors, clarity arrives after prices have already moved. Vanguard's 2025 market turbulence guidance warned that selling during turmoil often feels better in the short term because you stop the bleeding emotionally, but investors usually re-enter only after the rebound has started. JP Morgan's long-running market studies have also shown the brutal cost of missing the market's best days, which tend to cluster close to its worst days. That is the trap. You think you are reducing risk, but what you are often doing is guaranteeing that you experience the fall and miss the recovery. You keep the pain and give away the upside. What not to do before any April war spike. So let's get painfully concrete. Before April, do not reduce your 401k contribution below the level required to get the full employer match. That is not caution. That is voluntarily throwing away compensation. Do not move your whole account to cash because the headlines feel unbearable. Do not treat a 1-week or 4-week volatility burst as if it has authority over a retirement timeline that may still be 12, 18, or 25 years long. Do not let a war headline force you into pretending your time horizon suddenly collapsed. If you are more than 10 years from retirement, your problem is not that stocks became uncomfortable for a few weeks. Your problem is behavioral error. If you are close to retirement, the answer is not to panic liquidate equities after a drop. The answer is to make sure you have a safe bucket already in place. Schwab's 2026 guidance on sequence of returns risk emphasizes that retirees and near retirees need liquidity and stability so they are not forced to sell stocks in a downturn. That is a planning issue, not a headline issue. And one more thing, stop opening your retirement app every few hours. If you are not retiring this month, your app should not be your emotional weather report. The Warspike 401k protocol. Here's the framework I actually want you to remember. Not theory, not vibes, a protocol. Step 1, don't sell in the red zone. If the market is already panicking, that is the worst possible time to let your amygdala masquerade as a strategist. Step 2, keep the match. Protect employer match dollars first, because that is an immediate return you control, even when you control nothing else. Step 3, reduce checking frequency. Monthly is enough for most long-term investors. Quarterly is even better if constant checking triggers bad decisions. Step 4, hold 1 to 3 years of safe money only if retirement is near enough that withdrawals matter now. Not because stocks are broken, but because sequence risk is real when you must sell into weakness. Step 5, let the system, not headlines, run the account. That means payroll contributions continue, allocation changes happen only for life stage reasons, and no war headline gets to rewrite a decades-long plan in a single afternoon. This is the kind of structure that helps because it removes improvisation. Improvisation is expensive when your body is flooded with threat signals. Why long-term investors should think differently about falling prices. If you are still in the accumulation phase, meaning you are regularly contributing and retirement is not right around the corner, then a drop is not good news emotionally, but it can be useful news mathematically. Lower prices mean each paycheck buys more shares. That is the part your nervous system hates and your future net worth depends on. The product did not become worse just because the sticker got uglier. If your broad index fund still represents ownership in hundreds of companies, and if your retirement date is still far away, then what changed most in the short run was price, not purpose. This does not mean every market drop is a gift. It means the correct interpretation depends on your stage of life, or $150. The 3-day rule for people who feel like they're about to do something stupid. No allocation changes, no rage selling, no dramatic transfer to stable value, because the market had one ugly week. Day 2, audit only the things that actually matter. Your contribution rate, your employer match, your emergency fund, your debt pressure, and if you are near retirement, your safe bucket. Day 3, write one sentence that you will follow the next time headlines try to hijack your brain. Something simple. I do not make retirement decisions in a fear spike. Or my job is process, not prediction. That sentence matters because under stress, memory shrinks. You need a rule you can obey when you are not at your best. Reappraisal research matters here. Changing how you frame the event can change the intensity of the emotional response. You are not trying to become emotionless. You are trying to stop fear from becoming policy. Why humility beats confidence in this kind of market. The investors who usually get wrecked in environments like this are not always the least informed. Sometimes they are the ones who think they can outmaneuver every headline. They tell themselves they will sell now, buy back lower, then play defense until the war premium fades. That is a seductive fantasy because it flatters the ego. But markets do not hand out medals for sounding tactical. They punish late decisions. Reuters and AP both showed how violently markets have been repricing on each twist in the Iran story. Oil plunging on a pause, rising again on a denial. Stocks rebounding on hints of talks, then bracing again when those hints fall apart. That is not a smooth environment for precision timing by ordinary retirement investors checking a phone between meetings. That is an environment built to humiliate people who confuse confidence with control. The April question every viewer actually cares about. So what if April really is ugly? What if crude spikes again? The Fed gets boxed in and your account drops more before it recovers. Here is the answer nobody loves because it is not sexy. If your retirement timeline is long, the correct response is usually not heroic. It is disciplined. Keep buying. Keep the match. Keep the allocation aligned with your age and plan, not the news cycle. If you are near retirement, tighten the safe bucket and reduce the need to sell risk assets at bad prices. If you are already retired, protect spending liquidity first, but do not confuse prepare with liquidate everything. Reuters reported that analysts see a path to much higher oil if disruption runs through April. But that same reporting also makes clear how sensitive markets are to de-escalation headlines in the other direction. In other words, this is exactly the kind of environment where chasing certainty becomes expensive. The decision that will matter more than the war itself. 10 years from now, most people will not remember every briefing, denial, strike, pause, and rumor from this period. But many people will still be living with the financial consequences of how they behaved during it. That is the real point. The war may hit oil. Oil may hit inflation. Inflation may hit rate expectations. Rate expectations may hit your 401k. But only you can decide whether the final blow comes from the market or from your own panic. If this war has made you feel anxious, sick, obsessive, or tempted to hit the cash button at 1:17 in the morning, you are not broken. You are human. The goal is not to become fearless. The goal is to become structured enough that fear does not get a vote. So before April, do the adult thing that feels emotionally unsatisfying and financially powerful. Set the rules, protect the match, know your time horizon. Build the safe bucket if retirement is close, and then stop letting headlines audition for control of money you will not need for years. Because the people who come out of periods like this strongest are usually not the ones who predicted the next move in oil. They are the ones who refuse to let a war spike turn a long-term plan into a short-term mistake, especially when the scariest week often arrives right before the most important decision: not to flinch. Thanks for watching.